You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Well, hello, everyone. Welcome back to the podcast. Thank you for listening in. Today, I wanted to talk about the importance of the death benefit. I do not want that to be overlooked. Now, when you first discovered IBC, your first thought was probably, yeah, right. No way. How can anybody do this? How can this be true? Because I've certainly had my share of conversations with those who have said it's too good to be true. And I assure you, it's not, of course. It's absolutely great, and it's not too good to be true. And then as you started learning, hopefully reading books such as Nelson Nash's Becoming Your Own Banker or The Case for IBC, listening to podcasts, maybe watching some short videos, which some are good and some are not. I mean, with all information, right? You probably started to get more and more excited. Like me, I was through the roof excited. And also a little dumbfounded that I'd never heard of this before, as I'm sure some of you also have been. So yes, it is very exciting being able to build a pool of cash that you control 100% of, building a pool of cash that will be guaranteed to grow, allowing your money to continue to build and grow uninterrupted as you use and spend the money on things you need, things you want to finance, or things you want to invest in. I mean, how much better does it get than being able to earn forever this uninterrupted compounding interest on the dollars that you're spending in life so that you're not losing that earning power? It's pretty amazing. Being able to start an account from which you can access up to 50% of the death benefit for a chronic need, a long-term care need, even on day one. Premium is paid, tomorrow something happens, you can access up to 50% of the death benefit if you are able to qualify for a long-term care need, which is, again, being unable to perform 2 out of the 6 activities of daily living. That's amazing. That's something to get excited about. Of course, it's wonderful to be able to provide protection for your family. I mean, that's life insurance. And think about it. If you started the system because you were excited just about all the living benefits that it can provide, which is the primary reason people begin this strategy, they're primarily focused on the living benefits, not really so much the death benefit, although that does play in. So you're excited about saving into this new system that has all these amazing, cool benefits. And it just so happens to come with, let's say, $1 million of death benefit, of life insurance. Because when we're solving for infinite banking, for the infinite banking concept, and we're solving to build a policy that will be the best use for this strategy, we are solving for cash and for the cash to be efficient. And we're minimizing the death benefit on purpose. Because if you're minimizing the death benefit, well, that brings down the cost as well. So the cost is lower and more of your money can go towards building your cash value. So oftentimes when we're building these policies, the death benefit is kind of like a secondary thing because we're focusing on the cash efficiency, at least for the whole life. When we're talking about the whole life policy, the death benefit is like a side effect sometimes, and for a lot of people, that's how it feels. But just imagine you've just paid in, let's just say $30,000 in premium for the year. Now, again, it can be pretty much any amount, $3,000, whatever, depending on your age and your health. It can be minimal if that's what works for you. But the more you're able to save into it, well, the more you're going to have, the more you're going to build, the more you're going to have access to for financing needs, the more you'll have in retirement. So in this example, I'm just going to say, let's say it's $30,000. And tragedy strikes and you pass away. Yeah, big fat tragedy. So you pass away the very next day. And your family, instead of just getting that $30,000, which just the day before was sitting in your savings account, they're going to get a tax-free $1 million. And let's also think about how when you're paying that premium, that $30,000 is made up of 2 parts. It's made up of the base premium and the paid-up additions premium. And so that paid-up additions premium, when you sent that in, it bought and paid for more death benefit. So now instead of the million you started with, you might be leaving more like 1.1 million. And so you fund 30,000, you pass away tomorrow, your family gets 1.1 million. How amazing is that? Now, as a side note, I will say that if you were to actually pass away one day after acquiring a life insurance policy, or within the first 2 years of having your life insurance policy, there will be an investigation. The life insurance company is going to think, oh, something was wrong. Maybe we didn't get it right. Maybe they lied about something, and they are going to do an investigation. Now, I don't know if they're going to do, if it's something really obvious that didn't have to do with your health in any way, then likely they will not need to do an investigation. But that is something that they do in the first 2 years, is they check out just to make sure that there was no lying going on and that they received all the information and that you were honest. And if you did pass away in those 2 years and they found something that was dishonest or not stated correctly, they can just refund back basically the premiums. But otherwise, really all they need is a death certificate and they will pay out that death benefit. So anyhow, if you had that money, or let's just say you're trying to decide between fully funding your 401k for the year, maxing it out, or starting a whole life policy or funding a whole life policy. Now, if you decide to put that money into the 401k and then you pass away tomorrow, your family is going to get that $23,000 minus any taxes due. And let's not forget, the market could certainly have a bad day. Maybe the market had a bad day and dropped dramatically by 50%. Now your family is getting 50% of that amount minus taxes, rather than $1 million tax-free, roughly. Of course, there are more benefits than this that make the infinite banking concept very exciting. These are just kind of the main in-your-face, obvious ones. We simply must keep in mind the importance of the death benefit, especially if you have a family, a spouse, children, or someone depending on your income. It's important to think about the death benefit coverage, the total death benefit coverage, not just what the whole life is doing if you're deciding to start this strategy and you're able to contribute a certain amount because that's all you really can afford in your budget. We also got to be mindful of the total death benefit amount because we want it to be enough to protect that loved one, that person that's dependent on your income. We want it to be enough to protect them. In addition, the bonus for that is that term policy will be convertible because usually in order to get the death benefit to a higher total, but in an affordable way that allows you to focus on the whole life policy, we would just supplement with some term insurance, and that is convertible for you to grow your system. So it's a win for you in the long run as well. Now, of course, no one wants to think about dying. I mean, what a sad, sad topic. Nobody wants to think about it. Nobody wants to talk about it. And a lot of people think, you know what? It's going to be okay. My surviving spouse works. My surviving spouse will be fine without me. Maybe just a few $100,000 will be fine. They'll take care of them in the house. But really, it takes more than that. That may not be enough if you're thinking, or if you have no insurance because you think my spouse will be okay. But wouldn't it be nice if your surviving spouse could take the time to be able to mourn, or if you have children with your spouse or a partner, that time for mourning, those your remaining loved ones, the people that are still here, need to have that time to process the major tragedy that just happened. And rather than being just thrown into this frazzled life all of a sudden where there's no time to be sad, no time to be with the children, no time to mourn, because now we've got to be thinking about the bills. We've got to be thinking about, how am I going to pay this mortgage? Do I need to sell the house? Am I going to be able to afford every kind of bill you have? Utilities, phone, school, maybe you have school payments, all sorts of things. You just don't want to have to put your loved ones into that sudden and frazzled state of mind when they're very devastatingly sad. And again, when we're talking about amounts and how much coverage, a lot of times people don't think about the retirement savings that other spouse was contributing to as well. Maybe you were building towards a retirement goal together and both of you had a strategy to save money for the retirement. Or maybe the person who just passed was the sole person working or the sole person saving towards retirement. And now not only do you not have that cash flow today to help you with things today that cash flow would usually help you with, you also have that future cash flow you've lost out on that future togetherness, that future retirement goal, and all that potential for being able to enjoy a nice retirement for a retirement income that two incomes were saving for and two people were saving for to provide. A lot of people don't think about that. So it's good to think about these things and considering how much death benefit should I have. I'm going to close this one out with a story about a very close family member of mine who, before her retirement age, actually had to go on Social Security disability. Now, I had talked to her before about acquiring long-term disability at a time when she would have been able to acquire it, but she didn't feel she needed it at the time. She's like, I don't see why I would need that. That's just an extra expense. And then she did want to try again once she found out she was having a difficult time. It had to do with movement and walking. And then, of course, she was uninsurable. So she did not have long-term disability and had to go on Social Security disability and live on that measly amount from the government. And so she started to feel that she wasn't going to be able to afford her life insurance premium. She started coming to me and saying, I think I'm going to have to terminate this policy. I don't think I'm going to be able to pay it anymore. And she actually did want to keep it. She wanted to leave that legacy for her children and her family. She wanted to give that to them. And she liked that the policy was growing and that she had use of it and that the cash would be there for her. So she wanted it, but it was just so tight on her budget. She just felt like she was going to have to drop it. And unfortunately, when she did acquire the life insurance, she was already she wasn't in perfect health or in decent health. She already had this disability that was happening. And so they did not allow her to put the waiver of premium rider on the policy, which is one of my favorite riders to put on a policy, because if you become too sick or hurt to work, you don't have to pay the premium anymore, because just like it happened for her, she was unable to pay because her income went dramatically down. And now she has to try to figure out what she's going to cut out in life so that she can afford regular, just everyday needs. So she didn't have waiver of premium because she was not able to qualify for it. So she had to keep paying that premium even when she had very little income. So she came to me the first time and I said, she had some other bills to pay off. I said, why don't we take a small loan from here and pay off these other debts and then free up that cash flow that you're sending in those other directions and send a lower amount to yourself. And so she did. She says, yeah, I want to save the policy. Let's do that. And then another year or so later, she reached out again. I can't afford it. It's just too high. And so at that time, I said, why don't we drop the paid up additions rider? Because then your policy will remain in force and your premium will come down quite a bit. And then you maybe will be able to afford it. And so she said, yeah, let's do that, because she really wanted to keep it. So we dropped the paid up additions rider. And then maybe a year or so after that, again, she came and she said, I'm going to need to close it. I can't make this premium coming up, and I think I'm going to need to terminate it. But at that time, we were able to take a loan against the policy to pay the premium. So she was able to do that and then just continue the same loan repayment she already had going. And so that gave her some relief at that time. And then finally, she came to me again and she said, I don't know, I'm going to have to let it go. I don't want to, but I'm going to have to let it go. And I said, you know what? I think we're at a time period now where we would be able to stop the premiums and your contract would not become a modified endowment contract. It would not MEC. And so let me look into it and see if we can stop premiums and retain the policy. And so she was thrilled. She absolutely did want to do that. And so I looked into it and she was able to discontinue premium. And when that happened, her death benefit went down a little bit, but she did still have a death benefit and she was able to stop paying and she still had cash that was growing. And so it worked out. But then it was COVID. And unfortunately, she got sick during that time of COVID and went to the hospital for help. And in fact, they were no help. Actually, I feel like they were more harm than help. And after a few weeks of being at the hospital, and hopefully they were trying to help her, of course, nobody could go in and see her, they finally admitted they really had no one there who was knowledgeable enough to help her. So they moved her to another hospital a few hours away to get some good help. But by then it was too late and she ended up passing away. Broke all of our hearts and none of us could be there. And when that happened, she was able to leave that small legacy to her family. And I know that she felt good about that, knowing that she still had that. And she was able to leave something behind. And of course, it's going to help her family. She was able to leave that final act of love to them. They were able to use it to help pay for the funeral services, and, because it's always a burden. It's just something you don't want to pay for, whether it's a burden or not. It's just not a cost that anybody wants to pay for. And so it was great that it was able to help out and then also leave some funds for her family to be able to use for other things that they needed. And so the death benefit is important. It is so important. And especially if you have someone who's dependent on your income. So I just want to make sure that you're not overlooking the death benefit when you're looking into this strategy if you have those people that are dependent on you. And so that's really all I had for you today. If you would like to work together, if you'd like to reach out, you know where to find me, Valerie@alphaomegawealth.com. Now go hug your loved ones and have a great week. Take care.
This is thepodcastfactory.com.